All right, all right, all right. We are having fun today. Today, we're going to learn a little bit about the futures market. All right. We've got several questions that have come into me asking about the futures market in particular and how it's different from the stock market and how we can set some of these things up in the track and trade software, the trading platform that we use. And so, for those of you who don't know, my name is Lan Turner. I am a school teacher down at Utah Tech University, Southern Utah. And this is our laboratory class. And we also, of course, invite anybody else who wants to come and join us. You're all welcome. It is on YouTube. And so you're welcome to come and watch and enjoy and learn and participate in the class laboratory. So what we're going to do is we're primarily answering questions for students at this point. And one of the questions that we received was, how do the futures market differ a little bit from the stock market? Now, it's not that much different, all right? But there are a few things that we need to talk about when it comes to the differences between the futures and the stock market, so you understand when you're trading what you're going to get yourself into. First of all, the stock market is out of New York City, right? We had the New York Stock Exchange, we had the NASDAQ exchanges. That's one thing. And then the futures exchanges primarily are out of Chicago, all right? So Chicago is where I spent most of my time getting into this industry. I spent about 10 years going back and forth and working out of the Chicago area a little bit, out of Utah, out of Chicago, going back and forth to the exchanges back there. So my experience, my background primarily is the futures market. And then I, drifted over into the stock market, as everyone does. Of course, we have to trade stocks too, and that's a lot of fun. And so we do both, obviously. But the futures market is where my heart is. I love the futures market. And one of the big differences between the futures market and the stock market is just obviously the things that we can trade. All right. So when you're in the stock market, you trade Apple, Amazon, Netflix, Google, IBM. You trade stocks, right? Big companies. So companies are the ones that you're trading in the stock market. But when we go over to the futures market out of Chicago, one of the things that you trade in Chicago or the things that you trade in Chicago are primarily the commodities. All right, corn, wheat, soybeans, cattle. We've got all kinds of stuff in there. We can, well, let me show you in the track and trade software. You can see a list of all the things you can choose. Here's up here in the top left corner. This is a commodity chooser window right here. So you can choose all the commodities that you want to look at and have in your window. So you can see that we've got all kinds of currencies. Now these are in alphabetical order. They're not organized by sector. So you can see as we come down, we've got Bitcoin, we got Aussie dollar. So we've got currencies, Bitcoin, we've got Canadian dollar, we've got feeder cattle, copper, corn, wheat, soybeans, Dow Jones, Ether, Euro FX, more currencies. We got natural gas, we got gold, we got silver, we got lean hogs, Japanese yen, Mexican peso, NASDAQ. Now we do have the index as well. Here's crude oil. You want to trade crude oil and platinum and palladium and Russell. It's really fun. I mean, this stuff is really fun to trade. All right. If you get bored of trading, let's go trade Google again. Let's go trade Netflix again. Oh, did you buy yourself some Apple? Woo, big thrill, That's no fun. That stuff's no fun. Let's go trade some fun stuff. Let's trade soybean oil. All right. That's fun. You want to talk about some fun things to trade? Well, Lan, it's not all about fun. It's about making money. Well, you might as well have fun while you're making money. So this is fun. We like to trade this stuff. All right. So we got wheat, UST bonds. We got the indexes. Now, the indexes are very popular for trading in the futures market because of how much action they give you. All right. They give you a lot of action. So here you can see over here listed in track and trade. You can see on the right hand side, this is our control panel. And the control panel is what gives you access to all the features that are in the software. We try to put the control panel on the right hand side so it doesn't pop stuff up on the screen all the time. I really hate that when you're sitting there trying to trade and you're looking at your screen and you're like, oh, I want to change a color. of something, and suddenly, boom, you have this big screen in front of you. Oh, what's your color you want, Lan? You want to go from red to yellow? And it completely covers my whole screen, and I lose complete touch with the markets while I change a color from yellow to red. Stupid. All right. So we try and not do that in Track and Trade. Now, we are in a trading environment called windows. So their idea is that they like to pop up windows in front of everything you do. Oh, here's a window, here's a window, here's a window. So there are times where, even in Track and Trade, where we try to eliminate that as much as possible, that you're going to get a window that's going to pop up in front of your screen. So it is just the nature of the beast. All right. So, but we try to eliminate that as much as possible by putting it over in here on the right-hand side in what we call the control panel. All right. So this is your charts, and you can see over here, this is where you have your list of all the charts. And this is the things that are in this list right here are what we picked out of this commodity chooser right here. So you see, you got a little selection here, and everything that I've got selected in there. There's some I don't have selected, so they don't show up. So if we come over here, they won't be in that list. So if you don't need a whole list like this, now I have lots of stuff in here. Actually, it's this one here, the second one down. I have lots of stuff in here because I teach, lots of classes. And so we talk about lots of things. But if you're just going to trade, 4 or 5 things, if you're going to trade NASDAQ, Russell, S&P 500, maybe the Dow, and crude oil and gold. Maybe that's all you're going to, and corn. Don't forget corn. Everybody loves to trade corn. So you got those 7. Well, you can go up to the commodity chooser, pick those 7, and that's all that's going to be in your list. And you don't have to sit there and go down through and say, oh, well, okay, Japanese yen, platinum and palladium, T-bonds. I'm not going to trade any of those. Where's the ones I want? Where's the ones I want? So you can just limit that list down, and it makes it a lot easier. Again, like I said, I have a lot of them because I like to trade lots of things for classes. All right. So now we're going to come in here. And this is how you pick your commodity that you want to trade. Now, we have traditional commodities and, futures and commodities. You've heard them. They're kind of an interchangeable word when we're trading in Chicago. If you say, well, I trade futures, that means the same thing as, oh, I trade commodities. Basically the same idea. I mean, if you want to split hairs, you can say, well, commodities are just the grains, the wheats, the softs, the orange juice, and things like that are commodities. But in this world, we just kind of mix them all together and just say, I trade the commodities market. And of course, that can mean NASDAQ and S&P because it's in the commodities exchanges. All right. So you have the indexes. So you have the Russell, you have the Dow, you have the S&P 500, and you have the NASDAQ. Those are the 4 big indexes. And we like to trade those a lot over here because they have a lot of action. They move a lot. They move fast, so you can make money more quickly. You can also lose money more quickly. When you make more money more quickly, you can lose money more quickly. So you have to, trade wisely, just like you would if you were in the stock market, of course, too. Now, one of the things that we do over here in the futures market is everything is traded on margin. You don't trade in the futures market in a cash account. In the stock market, you can say, no, I don't want margin. I just want cash account. Well, they don't do that over here. And the reason is because they have different, what we call lot sizes, or commodity contracts is what we call them. All right. So you have different sizes of things, or different buckets. So because in the commodities market, everything's not done in dollars like you might do in the stock market. So in the stock market, everything's done in pennies and dollars, right? Pretty simple stuff. You want to go buy some Apple stock, you pay $350 a share, and away you go. It's easy to understand. Not quite so easy in the stock or in the futures market. So it's a little bit more complicated. You have to think about it in a different way, because what we do in the futures market is we have lots of different things that are measured in different ways. If you think about it, you've got corn and wheat and soybeans. Those are all measured in bushels, but yet we also have gasoline and we have crude oil. Those things are measured in gallons. And then we have gold and silver and platinum and palladium and copper. Those are measured in ounces. So how do you kind of meld all this together? Because they have to kind of work on the same table scales and all that kind of stuff. And it's a little bit hard to kind of Well, how am I going to trade so many ounces of gold converted into dollars versus how many gallons of crude oil converted into dollars? And so, how do we do that? So, the way we do it is we do it in contracts. So, if you think of a contract as like a bucket, all right. So, how big is your bucket? And in that bucket, we're going to throw some stuff, all right. Throw that stuff in the bucket. And each bucket is considered, we call them contracts. All right. So you have one contract. The minimum quantity that you can trade of anything is one. So that's one contract. But the bucket can be various sizes. All right. So you have, let's say, corn, for example. You can have a bucket of corn. So a normal bucket of corn has how many bushels in it, and how much does that one bucket of corn cost? All right. So now we have a key over here. So the key is very important in commodity trading. So we come over here. Let's first pull up corn. Since we're talking about corn, we'll come down here. We'll go to corn. We're just going to open up corn. And there's your corn contract. I'm going to turn on Heiken Ashi just because I like it. It smooths things out a little bit. All right. So that's our corn contract. And we're going to come over to the key. And you can see in corn, you can see it's the symbol is ZCU25. You know, in the stock market, we kind of get used to saying certain numbers of symbols, or we understand the symbols, like, for example, Microsoft, right? If I said Microsoft stock, most people are going to say, oh, that's MSFT. Okay, MSFT stands like Microsoft. We kind of, you know, or Google. If you're going to go buy Google stock, it's Google, Google, G-O-O-G, right? They've got a G-O-G-L. They've got another one too. So you got a couple of them. Or you've got IBM. What's IBM symbol? Oh, that's a hard one. IBM, right? So they kind of make sense because they're kind of shorthand of the company itself. Well, in the futures market, that's not quite the same. All right. So the symbol you can see starts off with Z in this particular case. And that tells you, I don't know what that tells you. ZC stands for corn. All right. And another thing is that U, see the U in there? ZCU. That stands for September. The U stands for September. You'd think that you would that have an S for September, but no S for September. They use U for September. And for December, they use Z. All right. Z is for September, or for December. But yet corn is ZCU25, and the Z doesn't stand for December in this case. So the symbols, you're like, what? No. Commodity symbols are stupid. You're right, they are. So we don't use them. That's the olden days stuff, right? We tried to eliminate having to use the symbols as much as possible in the track and trade platform because the symbols just don't make sense. And it's really hard. And they change. Every month, you'll get a new symbol. So you get a new symbol for every single month that comes along. It's not like IBM is the same IBM today as it was 25 years ago. Nope. Next month, you'll have a different symbol for corn. And then the month after that, you'll have a different symbol for corn. And then the month after that, you'll have a different symbol for corn. The 25 is obvious. That's for the year, right? The year is 25. But U, that's not very obvious, but that stands for September. And then ZC, that's just the symbol for corn, all right? So ZCU, September corn, 25. Why would we say September corn? That's another thing that's a little bit unique about being in the futures market. Everything has expiration dates, kind of like an option. So if you think of a contract, now over in the stock market, we call options contracts. We call them option contracts. In the futures market, see, and they want to screw you up. So if you're going back and forth between helicopters and airplanes, it's really hard to fly an airplane all the time and then go over and start flying helicopters. You might crash your helicopter. But I got 2 pilot's licenses. I can fly a helicopter and I can fly an airplane. Not a very wise choice, but you can do it, right? Because you get screwed up. Oh, if you want to pull up or push, or one does one does the other. Well, you know, it's kind of similar. Got a lot of the same stuff, but it's a little bit different. Well, that's the same thing with futures and stocks. A lot of the same things going on over there, but they're a little bit different. They're just enough that if you get over in the futures market, you might screw up your trade because you thought it was doing something in the stock market. And so the same as helicopters and airplanes. They both fly. They both do the same thing. They're both going to get you the same place, but the controls just a little bit different. Not that you can't fly both, have a pilot's license for a helicopter and a pilot's license for an airplane. Most people don't recommend it because you're going to get screwed up one time. You know, you might mess it up. Not that you can't trade futures and trade stocks. You certainly can. It's just that, remember, there's differences. All right. You got to understand and remember and know the differences. And so what we have is we have contracts that are different sizes based on the commodity that we are trading. So this is where some of the things that confuse people in the commodities market, people kind of shy away because they think it's hard. It's not that much different. Once you understand these 2 or 3 little things, it's like going from an airplane to a helicopter and then back again. You just got to remember that, oh, well, if I'm in the airplane, I have to do this. If I'm in the helicopter, I have to do this. All right. So I do this in the helicopter and in the airplane both. That works the same. That works the same. This works the same. This doesn't work the same. So there's just a few little things that you have to do that are a little bit different. All right. This doesn't work the same as this. All right. So there's different ways of doing different things. So you just have to get used to it. One thing we don't do is we don't pay much attention to the symbols in the futures market, just simply because they change all the time. They're constantly changing, and you can get used to it, and you can understand it, and you can read it, and you can remember that ZC stands for corn, and U stands for September, and 25 stands for the year that you're trading. It's not that big of a deal once you figure it out, right? But in track and trade, because that changes all the time, it confuses people. So what we do is we always write it out. So if you look up here in the top of the chart, you'll see corn, September 2025, which is just what this stands for. ZC is corn, U is September 25. Now, it's easier if we just write it out. And these little symbols like this came from back in the olden days when they used to have ticker tapes, right? And the little machine would go, and a little piece of paper would come out and they'd look at it. Oh, ZCU25 is at 3.9175. And then they'd go on and then, they'd get their little ticker symbol. And then the next little symbols would come out, and then the next symbol, and then once they got back around to corn again, oh, ZCU25, there it is again. Oh, now it's at 398,325. Oh, it's going up in price. So they would have to have those little stupid ticker symbols, right? Not stupid at the time. They were very neat new technology. But now that we've got these computer screens with giant monitors, I mean, look at the size of this thing. I got 4 computer monitors in front of me. I got more. I don't know if there's like waves of, I don't know, some sort of something's got to be killing me, having all of this computer stuff pointing monitors at me, right? I mean, all the I don't know. We got all this room. Why not write out the word instead of ZCU25? Why don't we say corn September 25? We can. We got lots of room, lots of display space. So we don't have to use all those cryptic things anymore. But because the commodities market hangs on to them and the exchanges, we fear change. We still have the old ticker tape symbols that they used to use on the ticker tapes, and we still use them today. And what's funny is if you go buy some trading platforms, they still use just the symbol. They don't have it all written out real nice and pretty for you. They just say, well, the symbol is ZCU25, and that means corn. And you're like, what the hell? Why don't you write it out for me so I can just say September corn 2025? Oh, we fear change. We fear change. All right. Fear change. We don't fear change over here at Gecko Software Track and Trade. We don't fear change. All right. All right. So we come in here and we write it all out for you. So when you come in here and you got your list, you can see all the names and see it's got the little symbol next to it. So Dow Jones Micro stands for MYM. If you need to know, that's what the symbol is. Gold is GGC. RBOB gas, that's unleaded gasoline, is GRB. See, so we do use the symbols, but we also use the name. Now, believe it or not, in this industry, it's not uncommon to see them not use the name, just use the symbol. And so you'll see a chart. Somebody will be doing a chart on YouTube or something, and they'll have some piece of shit software program. And all that's up in the corner is this little cryptic symbol, and you have no idea. You're like, I can't remember. I don't know what the heck is he trading? Where does it say? What is he trading? What is he trading? Is it IBM? No, he's in the futures market. What is he trading? I can't tell. All he's got is some cryptic little symbol up there in the left corner, and there's no name for the chart. Anyway, that's just a pet peeve if you can't tell. All right. So we make it easy on you. We try to write this stuff out wherever we possibly can. All right, so that's just a little history of the futures market and how we drag old technology forward into, and the stock market does it too. So don't just think that it's the futures market. The stock market drags all this old technology forward, and we just have a real hard time getting rid of it. But the futures market, even worse. We like to drag all kinds of old stuff forward. All right, so here we go. That's enough said about that, but that's why you're going to have some problems, because those symbols really are hard to understand, because they have, if you come in here, see if we can find some examples of this. All right, see that right there? There's your month contracts. Now, think about a commodity contract as something very similar to an options contract. All right, it's not an options contract. You can trade options on a commodity contract, but they work in kind of almost a similar way, in the sense that they have an expiration date to them. You know how when you buy an option, you say, oh, well, I'm going to buy my option. I'm going to buy a call option that has 3 months until expiration. Well, when you trade commodities, they do kind of the same thing. All right. They kind of do the same thing. And so they have, again, back to this old cryptic thing when they had the paper coming out of a little machine, a little teletype, miniature teletype machine. They didn't want to write out the word December because that was too long. And that didn't really match with something else they had with another symbol. So they couldn't use the letter D for December. So they decided that since December is the last month, they'll use the last letter of the alphabet to match up with the last month. So that's how they got that. So that ends up being Z or Z, whichever you want to call it. All right. So Z stands for December. I know it's weird how they come up with this stuff. I didn't make it up. But we still have to use it because they're dragging all that old teletype stuff forward into this futuristic modern world with 40,000 acres of monitors on your screen. All right. And right here, see that right there. So there's September 2020-25. U stands for September. 2025Z stands for December. 2026CH. H stands for March. January, February, March. ABC. Now, why do they like use Z, the last letter of the alphabet, for December, the last letter of the, don't try and figure it out, because it makes there is absolutely no sense whatsoever why any of this stuff is the way it is. It made sense to somebody back in 1950, all right? But it doesn't make any sense today. So March, H stands for March. K stands for May. N doesn't stand for November, like you just thought. Nope. N stands for July. U stands for September, and Z stands for December. Now, if you want to try and memorize those things, it'll help you by reading those little cryptic icons up in the left-hand corner that indicates what it is that you're trading. But that's how it works. So that's why it changes all the time. Okay. So you have the March contract. So that means that the contract is going to expire in March. Now, why do contracts expire? If I want to trade corn, how come I can't just buy corn like I can buy Apple or IBM over in the stock market? Why does it expire? It expires because somebody's going to eat that corn. And you're trading, in this case, we're looking at the September corn. This is the September corn contract, and this contract is going to expire. So if you're going to trade it, you have to be out by September. Otherwise, you might what? Take delivery because you bought it. So the neat thing that's cool about the futures market is that it's like putting the product that you're trading on layaway when you trade it. All right. It's like putting the product on layaway. So you have a future date that you're going to go back into the store and pay the final amount for whatever it is you bought. You ever put anything on layaway? You ever gone into Walmart? Ever gone into Shopko or some store, gone into Home Depot and said, I want to put this on layaway? And we used to do it a lot when we were younger and kids. I mean, I'm sure older people, I'm sure you've done it. Some of you have probably even put stuff on layaway. Tell me in the comments, have you ever put anything on layaway? But anyway, layaway is you go into the store and you say, hey, there's this widget I want to buy, but I don't have enough money to buy it today. So I'm going to put down 10%, and I'm going to put it on a shelf in the back room, and I'm going to come back in a couple months and I'm going to pay the rest of it, and I get it for today's price because that's when I bought it today, but I put it on layaway so I can make the payment sometime in the future. That's why we call them futures, because we're going to take and make delivery of the product that we are buying sometime in the future. Okay. So I'm going to put this on layaway. That's why we work on margin. Okay. We work on margin accounts, meaning that we'll put $10,000 into our account to open our account, right? But when we go and we buy corn's bucket, how big is the bucket of corn? How much corn is in our bucket? How many bushels of corn? Well, we come over to the key and you can see that the bushels of corn in our bucket is 5,000. There are 5,000 bushels of corn. Is that right? It's $5,000. Contract size is 5,000. So it's 5,000 bushels of corn in one contract, in one bucket. Now, 5,000 bushels fits in one train car of corn. Isn't that interesting? Right? So if you're going to take delivery of one contract of corn, you're going to get one train car of corn. That's 5,000 bushels. 5,000 bushels fits into one train car of corn. So that's how they do this measuring. It's like crude oil. If you're going to go to crude oil, how is crude oil measured? It's in gallons, right? But have you ever seen those big green barrels that come on the back of trucks, right? Going into gas stations and stuff. Usually out to farmers nowadays and stuff, right? That's how they bring oil in. They come in 55-gallon drums. You ever seen a 55-gallon drum of oil? Well, that's what's in it. This is a 55-gallon drum. So when we do oil, we do them in drums. How many gallons, how many 55-gallon drums are you going to buy with one contract of crude oil? It's kind of cool. You start thinking about it like that. Wow, how many ounces of gold am I going to be trading? How many ounces of gold are in one bucket or one contract? Now, the thing about the futures market is that there's different bucket sizes depending on how many you want, what you want to buy. So if you want to trade great, big, huge buckets, right? Like you're a big commercial entity, you want to trade big buckets of crude oil or big buckets of corn, 5,000 bushels. But what if you're little Land Turner from St. George, Utah? Well, I don't want to trade 5,000 bushels of corn. I only want to trade 500 bushels of corn. I want to trade a little bucket. Well, you can do that too. They let you we have in the futures market, we have standard contract sizes, we have mini contract sizes, and we have micro contract sizes. All right. So that's really just the different sizes of buckets. So we got a big bucket, we got a little bucket, medium-sized bucket, and we got a little bucket. We got Papa Bear, we got Mama Bear, and we got Baby Bear. All right. So if you're just brand spanking new to the futures market, well, you might want to trade the micro size buckets, the little tiny buckets. All right. So until you get used to it, figure it all out. See if you can make some money trading the little tiny buckets. And then you're like, well, hey, I can trade those little tiny buckets. No problem. I think I'll move up to a bigger bucket. Saves you on commissions and it makes it easier for you. It's just easier. You can trade a bigger bucket. You make more money with doing the same exact thing. No reason to trade 50 of these when you can just do 5 of these. No reason to do 5 of these if you can just do 1 of these, right? So it's just bucket sizes. So the way you get the different bucket is you don't type it in or something like, oh, I want 2 bucket size or a 4 bucket size. You kind of do that in the Forex market. However many of you have ever traded Forex. Some of you are familiar with Forex. We used to do that in Forex platforms. You used to go in, what's your bucket size? Basically, is what your leverage was. I would like to have 2x leverage. I would like to have 3x leverage. And then it would calculate out the different sizes or how much money you were trading, because they would do the same thing. They have different contract sizes in the Forex market, right? But we don't do that over here in the futures market. We just do different bucket sizes. So what we do is you come in and you can see in here, like, for example, let's come down to crude oil. See this right here? This is crude oil. See, that's just the NYMEX crude oil right there. It's GCL is the symbol, but it's just light crude oil. It's traded on the NYMEX, which is the exchange. And then right underneath it, you see that we have light crude oil, which is a micro, and we all have several light crude oil, which is a mini. So there's your 3 crude oil sizes, buckets. That's why you have 3, right? This one isn't labeled because it's just the normal bucket size. So they don't put micro, mini, big, biggie, smallie, Papa Bear, Mama Bear, Baby Bear. They just come in here and say, this is the crude oil contract. Oh, but I'm a littler guy. I'm not the big guy. I want a little bit smaller guy. Well, okay, then you use the mini. All right, that would be the mini size. And then, oh, I'm not even that big. I'm beginner. I'm brand new at this. Oh, well, then you want to come in and you want to do the micro size. All right. So you got the 3 contract size buckets. Now, the thing is about the bucket sizes is there's nothing really different other than how many you're buying. So they all basically trend the same way. They all move. The price is the same. They all have everything is the same except for the size in which the amount of money you're trading. So if you come in and let me show you, for example, we'll go in and we'll pull up the crude oil contract. All right. And we're going to pull up the September, which means it's going to expire in September, which means we're going to put it on layaway. Whenever we put an order in, we're going to put up 10%, like we're putting it on layaway. We're going to put up our 10%. They're going to take it and put it on the shelf for us. That's Land's crude oil. He's buying the full size crude oil. And he's going to put up 10%. And he's going to put that on the shelf. So that means he's going to either come back in September sometime and he's going to pay me the rest because he's only going to give me 10% right now. This is why that's what's called margin, right? You're on a margin account. So you're going to put this on layaway, give him 10%, that holds it for you. And then I'm going to come back and pay the rest and take delivery at the end of September. But Land, I don't really want to take delivery. I just want to put it on layaway. So what's the point? I don't get it. Well, if you own it, basically, once you own it, if it goes up and down in value, you make or lose the same amount of money, the amount of money that it makes or lose because you own it. I mean, you get to buy it at the price you lay it away for. That's why you put things on layaway because, hey, it's on sale today. Oh, well, I don't have enough money to buy it today. I'm going to go into Costco and I'm going to put this on layaway at today's price because it's on sale. So I'm going to put it today's price on sale, but I'm not going to take delivery of it till sometime in the future. But in the meantime, it's going to go up in value because it's no longer on sale. But when I come in and buy it, take delivery of it, I get to buy it at the sale price, even though it's trading at a higher price. So I get a good deal. I get a bargain, right? And that's what we're doing when we're buying and selling. We're looking for a bargain. We want to buy low and sell high. So, but Land, I don't want to take delivery. I don't really want any crude oil. I don't really want a train full of corn. All you have to do is just sell your position before the delivery date that you bought. No harm, no foul. And Land sold his position to somebody else. So that person now gets to come in and take it off of the shelf and gets to take delivery. And you don't have to because you sold your right to buy it at the sale price to someone else. That's all that's happening. So you buy low, sell high. You're putting something on the shelf, something sitting there on the shelf so that you can take delivery of it at the price you put it on layaway, but then you sell your right to buy it at a different price, which is higher than what you bought it for, right? And that's how you make money. Buy low, sell high. And you don't have to take, or whoever you sell it to doesn't have to take delivery until sometime in September when the contract expires. Just like an option. An option expires too, right? You have a certain amount of time to offset your position and you'll never take delivery. You don't have to take delivery, right? When you register, when you open up your account, they're going to say, are you somebody who will ever take delivery? And you say no. So even if you screw up and it goes into, delivery date and oh crap, I went on vacation while I was trading futures and I didn't realize it. And now they want to take delivery. No, they're not going to actually drop you a bucket of, a truck of soybeans isn't going to pull up and drop that on your front porch. It's not going to happen. What that means to you is money. It means they're going to take money from you for making that mistake. All right. And your broker will probably just get you out before then anyway. And that'll cost you money because he's going to do it for you. So that'll be a fee that he's going to charge you. If it does go into delivery, which it probably won't because you're already going to tell them you're never going to take delivery, your broker should clean it out or your clearing firm will clean it out for you, offset your position for you and take it off the shelf and give it to somebody. It'll end up being storage. Oh, you left it at the store and you didn't come and pick it up. Well, now you have to pay storage fees on it while it sits at the store. You put it on layaway and then you never come to collect it. The date came due and it's still sitting there on the shelf. You just have to pay storage fees on it. Nobody wants to pay storage fees on, 25 head of cattle. Can get expensive. Don't ask me how I know. I don't know. I've never done it. Never had a delivery contract go through. I always pay very close attention to my trades, and so I'm always out of the position before the expiration date. All right. And another great thing about Track and Trade is it'll draw the little expiration dates right on the screen. Look at that. This is your first notice dates. This is the day you have to be out of the contract. Don't be in there after that yellow date. Get out, right? This is a September contract. Run into the store and either offset it or take delivery. If you want to take delivery, go ahead, take delivery. Nobody cares. I mean, oh, you want some corn? We'll send you a truckload of corn. All right. But probably not. Most of us here probably don't want to keep the corn or the crude oil. So we got to get out of it by that yellow line, right? And then this one here is the expiration date. That's the day the actually contract is over and they actually make delivery. So these are your warning signs. We actually draw those right on the screen for you so that as you're trading along, you say, oh, I got until here until I need to get out of this market and then roll over to the next one. So you can either roll over, so it's rolling. All that means, oh, I'm making all kinds of money in corn. I want to stay in there. Why would I want to get out just because the contract expires? Well, you have to get out or else you're going to take delivery. So what you do is you sell this one and you just buy the next month out. So you can say, well, what's the next month out on corn? Let's come down and look. Come in here, you pull up corn and you say, here's corn. Oh, the next month out's December. So you open up December corn and you say, which one should I trade, Land? Should I trade December corn or should I trade September corn? Well, it just depends on how many people are trading whichever one the most. Right here, this is called volume down here, right? So we know what volume is. Volume is the number of contracts that are traded hands. And you can see that more contracts are starting to trade hands. Clear back here in February of 2025, wasn't a whole lot of people trading the December corn contract, which expires in December. So as it gets closer to December, more and more people trade it. So the more and more people that trade it, that makes it easier for us to get in and get out of our contracts. We get in, we want to be able to get out so it doesn't, cost us money. So you want to have lots of volume. So you can come back and you look at the September corn contract and you're like, well, September corn contract's starting to come to an end. So you can see volume's dropping off, but it was ramping up. It was going up in here. So you could trade September contract in here. You always want to trade what we call the front month. All right. That's the one that's going to expire next, because that's usually where most of your friends are going to be, right? And friends are the ones you want to trade with. So that's where you're going to get a big bump in volume. And that's where you want to trade these contracts. Now, if you're only trading onesie, twosies, like most of us do, twosie, threesies at the most, we don't go in there and trade 50, 60, 80 contracts. We usually don't have that big of a problem getting our contracts filled. All right. So if we're just trading onesie, twosies, we can get them filled pretty easily. But for people who, trade lots and lots and lots of contracts, and of course that helps with the slippage and the spread is tighter when you have more volume and stuff. So you always want to kind of trade the ones that have the most volume. But right now you could look at September and you can say, well, the highest peak of September was 205,000 contracts in one day, and it's currently trading at about 115 contracts. Well, what's the corn December doing? Well, corn December is right around 136 versus 118. Well, it looks like right now you could easily move into the corn contract, the December contract, because there's plenty of volume. Lots of people are trading it. In fact, more people are trading the December contract right now than they are the September contract. And that's because the September contract's getting ready to expire, right? There's only 4 weeks left until you hit that first notice date. So people are moving over into this contract here. And you can slide out into the future on your chart and you can say, oh, look, way out there's your exit. So I got lots of time to trade the corn contract. I can trade all through here before I have to get out of the contract. Now, all you have to do to get out is just sell it or buy it, because think about it. What if you go in and you know that that pair of pants down there at the grocery store or down there at Costco, does Costco sell pants? You go down to Costco and they have a set pair of pants, and you know that they're going to go on sale next week. I don't know how you know. Insider trading, maybe. Maybe your buddy at the counter said, hey, next week that pair of pants is going on sale. And you're like standing there getting ready to buy it. Oh, really? Okay, I think I'll put it back on the shelf. In fact, you know what I'll do? I'll go put it on I'll go put it on layaway. And then when it goes on sale, I'll come back in and say, hey, that's on layaway. I want it on the sale price now. And they'll probably give it to you, right? That's shorting the market. Now, shorting the market means you make money when you sell first at high and you buy it back low later. All right. That's just trying to make a little Costco joke with you. But Don't do any insider trading. That's not good. All right. Somebody got in trouble for that once. I know a lot of people, a group of people out in Washington, D.C. who do it all the time. They never get in trouble, but that's neither here nor there. We're not those people. So therefore, we don't want to do it. All right. Don't you do it. Well, you'll get in trouble. Promise. All right. So we're going to come in here, and it's pretty hard to do insider trading in corn. Corn's going to go down. How do you know? Well, I got a USDA report, and it hasn't been released to the public yet. Well, that would be insider trading. That'd be pretty cool if you could get that information, right? You guys ever see Trading Places, the movie Trading Places with Dan Aykroyd and Eddie Murphy? If you haven't seen that, you need to go get it. You need to go watch that movie. Trading Places with Dan Aykroyd and Eddie Murphy. It's all about commodity trading. All right. And they do all this stuff. Well, they do it with orange juice. Okay. So it's a fun movie. Go watch it if you haven't watched it. So, all right. What have we not talked about yet? Bucket sizes. We figured that out. Contracts expire. We figured that out. Buying low, selling high, buying low. They let you do that. You can sell it first. You can sell something that you don't own and buy it back at a lower price and make money when the market falls. And they let you do that because you're on margin, but because you don't have to take or make delivery until sometime in the future. And all you have to do is just offset your contract. So that's how you trade in the futures market. All right. Because you don't have to take delivery or make delivery, because if you sell it, that means you have it, right? If you sell something, you have it. Therefore, if you have it and you sell it, you're going to make delivery of that thing that you sold. Let's say you got a car out here, you sell it, right? You sell your car. Well, now you got to make delivery. Well, I'll make delivery to you next week. All right. Well, that's called shorting the market. You sold it. Now you got to make delivery. Okay. Because that's because you have the car. All right. But if you don't have the car, then you're going to buy it, right? I'm going to buy the car. I don't have a car. I'm going to buy the car. And now they're going to make delivery to me next week. So as long as they're making delivery to you next week, it's in the future. Therefore, you have the opportunity at one point or another before that car is delivered to offset your position and either make or lose money, right? I bought the car for this much. They're not going to deliver it to me. I bought the car for $10,000. They're not going to deliver it to me till next week. So what I'm going to do is I'm going to sell the car before they even deliver it. I'm going to sell it to my buddy across the street for $11,000. And then when they deliver the car, they'll deliver it to him, not to me. That's how the futures market works. All right. So you can do it just the opposite too. You can sell something to your buddy. Okay. For your friend across the street. Hey, I'm going to sell you this car for $11,000. Oh, okay. I'll buy it. Now you got to make delivery to him. So you go and wait for a week until you can buy it for $10,000, and then you deliver it to him, and they deliver it to him, and now you just made $1,000 because you sold it to him for 11, waited for a week, prices went down, you went and grabbed it, bought it for 10,000, and had him deliver it to him. He pays 11,000, they give you 1,000. That's how you make money on a short sale, right? That's how you make money when the market goes down. You sell first and buy back low later. That's because they're not going to deliver it till sometime in the future. So all you have to do is just offset your position. If you sell first, buy back, you make money. Or you buy first, sell later. They let you do it because of the delivery out in the future. That's why futures is really cool. Okay, and we do it on margin. And because you're putting it on layaway, all you're putting out is 10% of the overall longer term value. So when you buy the car, you don't even have to buy the whole car. You just have to put down $1,000 and you just control that $10,000 car. And then whether the value goes up or down, you get to make that profit, even though you only put 10% down. That's called margin. All right. And that's all in the key over here. So you can see right here, the contract size, you're going to control 5,000, in this case, bushels of corn, and it's in bushels. It's the tick unit is in dollars. The minimum move it can move is 25 cents. Currency, the exchange it's traded on is the Chicago Board of Trade. The expiration date is 12/12/25. That's the date you have to be out of this contract or else take or make delivery. First notice date is 11/28. That's what these lines here are, right? This is 11/28. This is the expiration date. And now you have initial margin, maintenance margin, and day margin. Let's talk about those for a second. What is that? All right. When you go in and you're going to make a trade just within the open and close time, which is right here, open climb. Now, in the futures market, many of these contracts will trade 23 hours a day. Not all of them. The traditional commodities, wheats, corns, grains, things like that, softs, orange juice, coffee, things like that. They have smaller trading times. All right. So, for example, notice that the open time is at 6:00 p.m. That's weird. Why does it open at 6:00 in the night? It's just what they do. So there's not like an opening bell, like at 7:30 in the morning. Corn doesn't have an opening bell. All right. So it actually opens at 6:00 p.m. and it closes at 12:20 p.m. the next day. So it opens at 6 p.m., trades all night long, and closes at 12:20 the next afternoon. That's kind of weird, right? But that's how they do it. All right. So let's come and look at something else. Let's come down here and look at crude oil. All right. So we'll go to oil. We'll go back to our crude oil contract, and we'll come up here to the key and notice that at open time is at 6:00 p.m. Close time, again, 12:20. So they do the same thing as corn. Why? It's a commodity. That's what they do. All right. So let's come in and look at something else. Let's come in and look at the NASDAQ. All right. There's the NASDAQ. We love trading the NASDAQ. So there's the NASDAQ. Right. What's the NASDAQ? The NASDAQ is an exchange out of New York, right? And the NASDAQ 100 is the 100 biggest best stocks in the NASDAQ exchange. So this is actually a stock index. You can trade it in the futures market. The same thing, because you can take delivery of the NASDAQ stocks. The September contract, if you slide out there, oh, sure enough, there's a red line that says that it's going to expire, and you can trade the contract. And you can trade how many contracts right now? Let's go over to the key, and you can see it trades. In this case, $20 is the contract size. $20 times however many contracts you're trading would be $468,525 right now. That would be one contract. The price of $23,426. $23,000 for one contract. But you can see you can put it on margin. For one day, just to trade the day margin is only $2,000. So you only have to put up 10% to trade $23,000, which is $468,000, controlling $468,000 worth of contract. That's crazy. So that's how you can make so much money trading these markets, because you're not putting up the full amount. You're putting up a margin amount. Now, a margin amount over in the stock market is generally 2, maybe if you're lucky, you can get 3 or 4%. Over here, it's like 60 or 80%. 60% is your margin amount, right? You put up a 10%, that's a pretty damn big margin, right? So that means that if you come in here, and let's pull up the NASDAQ. This is the mini. Let's pull up the NASDAQ micro. All right. So here's the micro and the mini. So now we got the micro right here. See that? See how it says micro? We're just going to go to the 1 minute chart. We'll go to the 1 minute micro and the 1 minute mini. Notice that they look at, I got too many indicators on. Let's just remove some of them. So there you go. Oh, let's ATR. Let's get rid of this one here. Let's get rid of that one there. All right. So we got the chart, 1 minute chart on the mini, and we got a 1 minute chart on the micro. It looks almost identical, doesn't it? It should look pretty darn close, because they're the same thing. The only difference is the lot size, right? Or how big the bucket is. Okay. The contract size. So it should trade about the same. The only difference is the contract size. But watch this. We're going to take our dollar calculator, and we're going to go, this is the mini, and I'm going to go from the top to from the high of this peak. Let's just go to where it's currently trading. That is 518 ticks. And in the mini contract, that would be $2,590. And how much money would you have to put on to make that trade, to sell right here and buy right here? It's easier if we do it the other way. A lot of people don't understand the short side. Even though I tried to explain it, they still are like, I don't get it, Land. How can you sell something you don't own? They just let you do it because you're going to deliver it in the future. All right, so we're going to go from this low high to where it's currently trading. That would be, now you can't see it. Doggone it. Let's just do this one here. Can you see that one? Yeah, let's go to where it's at. Let's just move over here. I think I'm trying to get the text so you can see the text a little better. Yeah, where can we see the text? There it is. That's a little better. All right, $1,660 for one contract. The minimum move, one size, one contract. It's right there, $1,660. All right. So if we come over here and we go to the micro one, we're going to do the same thing. We'll blow it up like that. And now we're going to come in here and we go like this up to there, $169. Same looking chart. It's a different chart, but it's the same chart, right? It's the NASDAQ, but you're going to make $169 on the key, which is right here, the day margin of $171. So you only have to have $171 in your account to trade the micro. And from this low point right here, this is just a 1 minute chart. So each one of those price bars represents 1 minute. So what is that? I don't know, 30, 60 minutes, maybe an hour. So from here to here, that'd have been $168 with a $171 investment. That's because you have leverage. You're controlling $23,000 worth of NASDAQ. All right. Or the current price is $23,000. Sorry. You're controlling $46,000 worth of NASDAQ. So when you buy one contract, it's $46,000, but you don't have to put $46,000 down. That would be if you were in a cash account. So if you're over in the stock market, to make that much money, you'd have to put $46,000 down. But over here, you only have to put $171 down. That's crazy, right? So you get to control one contract for $168. Now, if we go over to the NASDAQ 100 September, there's the 1 minute chart. That's $1,660. But instead of $171, you had to have $2,094 down. So that's your layaway amount. You have to put that money on layaway. All right. So to put down and control, and look how much that you're controlling. To put $469,000 of the NASDAQ on layaway, they're going to make you put down $2,000. So you got to put $469,000 of NASDAQ on layaway. And they're going to say, well, to do that, you got to have $2,000. Okay, so you give them $2,000. You now control $469,000 in NASDAQ. So if that $469,000 goes up that far, well, you get to make $1,660 while you hold that on layaway. You don't actually have to actually put up the full $469,000 because you're on margin. You got layaway. All right. So to get rid of it, all you have to do is just sell it up there, sell your contract. So you buy low, sell high, and you're out of the contract. You don't have to take delivery of the $469,000. You don't have to make delivery of the $469,000. Does that make sense? So that's how it all works. So all you have to do is you have to just come in here, and to trade, it's very simple. You say, well, I want to trade the NASDAQ. This is the mini. If I think it's going to go up $469,000, I have to have $2,000. Well, I got plenty of money. So we're going to go in here. All you have to do is just hit buy. You now have $469,000 worth of NASDAQ that you're trading. It doesn't have to go up very much to make a lot of money. Well, we're up $85 already. Oh, go out, get out, exit chart. Oh, we just made $60. Just like that, we just made $60. And all we had to have was $2,000 in our account to do that because we're controlling $465,000 worth of NASDAQ. Let's go back over and do the same thing. We'll do the same thing over here with little micro. Here's the little micro, right? So let's do the same thing. We come in here, we're going to go buy. And all we have to do is sit here and watch the little micro, see if it'll go up. Oh no, it's not going up. It's going down. I want to get out. I'm losing $8. All right. Wait for a minute. Maybe it goes up. Don't wait too long. Don't let it go a long ways against you. There it goes. Now it's starting to go up. Oh, now I'm up $4, $3, $7, $6. So you can trade the micro or you can trade the mini. It doesn't matter. It's just how much money you're going to make when you make the same trade because you're controlling different amount of money. How much did you put on layaway? There we go. Let's get out. Exit chart. We just made another $14, right? So we made $15 on our micro and we made $60 on the mini. There you go. That's how you do it. I think that kind of covers pretty much what I wanted to cover. Now, there's lots of other settings and lots of stuff you have to learn. So I would recommend that you just keep coming to class. Come along and do this with me. Right now we're on summer session. I'm a school teacher, and so I teach the summer classes right now. These are summer classes. These are summer labs. And I'm not actually teaching the academic side of classes during the summer. I'm off, right? School teacher. We're off during the summer, but I'm still teaching the labs. I'm still staying in touch with you guys, working with you, helping you understand all this stuff during the summertime. And starting mid-October is when I start teaching down at Utah Tech again. So I'll go back down to St. George. Right now I'm up in my summer home up in Logan. And in the fall, I'll go back down to my winter home, which is down in St. George, and start teaching classes down there. And when that happens, if you're in the St. George area, you can come to my classes at the university. They're night classes, so everybody's welcome. You're welcome to come and take my classes at the university. And then we do the labs during the afternoon when the markets are open, because my night classes are, well, they're at night, so the markets are closed. Now, the futures markets are not closed, so we can do a little bit of futures trading in class, but mostly in class we do the academic side of things, where we learn all this neat stuff about the markets, and then we go and we trade the markets during the day on YouTube as our lab, because it makes it easy. Everybody can come and join, right? So that's what we do. So right now in the summer session, we're just doing Tuesdays and Thursday mornings for the stock classes, the stock lab. And then once a week, we meet in the afternoon at 1 o'clock for power hour on Wednesdays. That's what we're doing today. So today is Wednesday, and we do the futures market. And the market's going to close here in 1 minute. I guess the market just less than 1 minute. The market's going to close. All right. Now, that is the New York Stock Exchange market. Now, remember, we're in the futures market. So this is the NASDAQ. If you look up here, it's not going to actually close. The close time is at 3 o'clock, not at 2 o'clock. So we got 1 more hour that'll continue to trade. Now you just say, well, Len, that's just after hours. That's true. In the stock market, it's after hours. In the futures market, it just closes at 3. Well, what's the difference? Well, in the stock market, after hours means that you can only use limit orders, right? When you trade the after hours, you can only use limit orders. In the futures market, after hours, the last hour, the 4 to 3 o'clock, or the 3 to 4 o'clock, is from 2 to 3 o'clock. What time is it? Oh, that's the close. Closes at 3 o'clock and it's 2 o'clock. So from 2 to 3 o'clock, there's no change. There's no different. You're not restricted to just using limit orders. And then another restriction that you don't have in the futures markets, you don't have any pattern day trading rules. Pattern day trading rules say that you have to have at least $25,000 in your account to day trade, right? Not so when you're in the futures market. There are no pattern day trading rules. So you can have $2,000 in your account and trade to your heart's content. Hit that buy and sell button 1,000,000 times a day if you want. Nobody cares. All right. It's last bastion of true capitalism on earth today. All right. The futures market. That's why we love it. And it's a lot of fun as long as you can understand those few weird little things. Contracts, they expire, and the symbols are hard to understand. All right. Those are kind of the major differences. If you can understand that and understand that you always want to be trading the front month, the one that's going to expire next, that's where all the volume is, and that's why you want to trade that one, then things are pretty much the same. It's pretty simple, buy low, sell high stuff after that. And that you're on margin. You're putting stuff on layaway. So you don't have to have a big chunk of money to make a large amount of money. You have a small amount of money, makes a large amount of money. Of course, whenever you have a small amount of money can make a large amount of money, a small amount of money can lose a large amount of money too. So you have to be careful. A lot of risk and money management strategies that have to take place in the futures market. All right. So that doesn't mean you don't have to do those in the stock market. You certainly do. It's just the risks are not nearly as great, All right. Does anybody have any questions that I can answer before I let you go? Let me come over here and run a few things for you that are fun to see. Just for fun, here you go.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so if you come in on Wednesdays, now when school starts in October, we'll start teaching every single day here on YouTube. All right. We'll do Monday, Wednesday, and Friday will be the labs for the stocks. And then Tuesdays and Thursdays, we do the lab for the day trading futures. Not that we don't do day trading in the stock market, we do, but that we do those on Monday, Wednesday, and Friday. Mostly we do investing type stuff, but we still do some day trading stuff too, because it's fun. We like to do it. All right. We want to have fun while we make money. And that's the name of the game. So any questions before I let you go? Any questions? All right. Let me come in here and show you one more fun thing. This one here. All right, let's show you. Claire's got something she wants. Oh my goodness, look at that. The market's taking off like a rocket ship. Right there at the close. Or just after the close. Wow, look at that go. Maybe we had some earnings come in after the close because it's closed. Market closed 3 minutes ago. Look at it go. Wow. That's fun to see. All right, let me run this by you for a second.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right, guys. And if you haven't picked up Pitt News Magazine, the new version drops this Friday. We're waiting for compliance. Typically, we drop the new Pitt News Magazine on the first Monday of every month. So this Friday would not be the first Monday. It would just be the first of the month, not the first Monday. But if we can get it approved through compliance by Friday, we'll ship it out on Friday. You can have it for the weekend. All right. So I'm really excited about it. It's a lot of fun. I'm a little shy, if you haven't realized. This magazine is a lot about me. Claire took over as the assistant editor of the magazine, and the very first editor magazine, the very first one, she made me the subject of the magazine. So since I'm so shy, I'm a little nervous having this one come out, but it's gonna be fun anyway. All right, even though it's a little bit about me and how I got started. So we'll do that one on Friday if we can get that out to you. If you don't have Pitt News Magazine, well,
look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
That's right. If you don't have Pitt News Magazine, you must have something wrong with your brain. Go over to pittnews.com, pick up a copy, and it'll come out to you. This version will come out to you. The next version, upcoming version, will come out to you on Friday, maybe Monday. And as far as that goes, we got a class tomorrow morning, stocks class. Don't forget that. Come and join us tomorrow morning, 8 o'clock in the morning. We'll see you then. All right, guys, that's it. That's all I got for you today. Hope you learned something. Hope this helped. And we'll see you tomorrow morning, 8 a.m., bright and early.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.